Hi, and welcome back. Um, we're on to chapter 13, so we're jumping around the textbook, but that's okay. We're doing it in my order rather than textbook order. And today we're going to talk about what accountants call cost allocation. And this is a concept that most non-financial people don't really understand because they think about it in a different way than accountants think about it. So, in your personal life, you think about something called depreciation. You buy a car and it loses value, and we call that depreciated or depreciation. And in accounting, we use those same terms, but they don't really mean the same thing. We're not when we calculate or allocate cost for a car or a truck or any asset, what we're really doing in accounting is putting the cost across the useful life of the asset and using that principle that we've already talked about, the matching principle, to match the expense with the revenue. So cost allocation is something we do with long-term assets, assets that have a life of more than 1 year, so they span multiple periods of the income statement and the balance sheet. And therefore, we need to allocate the cost over their long-term life. And we do that by matching those costs to the output or the revenue generation of those assets. So that's what we call cost allocation. And there are actually 3 terms for that in accounting and finance. And they all mean essentially the same things, but they have the jargon in accounting is very specific, so they all mean very specific things, and we'll talk about that as we go through this chapter. So depreciation, which I just mentioned, is a cost allocation. Amortization is also a cost allocation, and depletion is also a cost allocation over time. They apply to different kinds of assets, which we'll talk about, but they mean pretty much the same thing: allocation of an asset's cost over its useful life. If you look up depreciation in the dictionary, what you'll see is it says a decrease in value, but that's not really what an accountant is looking at. An accountant is looking at, we paid this for it, we're going to use it for so long, we need to allocate that cost over the useful life of the asset. So the little graph there, we have a cost at the beginning, we have benefits from the asset over 4 years, in this case 4 periods. So we're going to allocate part of the cost to each of those periods. So when we're thinking about cost allocation, I'm going to continue to use that word a little bit, and then we'll get more into the accounting words. When we're thinking about cost allocation, there are certain things that we need to know. We need to know what we paid for something. So what the valuation of that asset is. We need to know how much we're using it. And we may also need to think about the tax implications of cost allocation. And we'll talk about why that's an important thing to think about in a little bit more depth later on. But to begin with, let's just say that the tax cost allocation might be different from the accounting cost allocation. And that's generally allowed in most tax systems, so we'll talk about that a little bit as well. So there are 3 words: depreciation, depletion, and amortization. Depreciation is the cost allocation of tangible assets, so things you can touch. A building, piece of equipment, automobile, a truck, anything that's tangible, things that I can touch, is what depreciation, the word depreciation means. So cost allocation of tangible assets. Depletion is the cost allocation of natural resources. So when we own and have a cost for natural resources, they're sitting in the ground, generally speaking, and we allocate the cost of those resources over the time that they're useful. So when we pull them out of the ground, they become useful, but we own them, we've paid for them as they sit in the ground, so we have to come up with a method to allocate the cost of those natural resources over the useful life of those natural resources. And then the third method, or the third word, is amortization. And once again, means the same thing, cost allocation, but it applies only to intangible assets. So we amortize trademarks, we amortize patents, we amortize franchise agreements, we amortize things that are intangible, things we can't touch, generally legal agreements of one sort or another. Also, we'll talk a bit about goodwill, which is another intangible asset. So those are intangible assets. I'll pause for one. So back again, just tried to fix the camera so it wouldn't be so annoying, focusing in and focusing out on my face. Not sure why it was doing that. So property, plant, and equipment are tangible assets. So tangible assets are land improvements, building, equipment, and natural resources. So all of those things are tangible assets. They have physical substance. Intangible assets are patents, trademarks, copyrights, franchises, goodwill, and there's more, but those are the primary areas of intangible assets. Those are things that you can't touch. They are pieces of paper or concepts. So we call them intangible. And we treat them a little differently in terms of cost allocation. So for tangible assets, property, plant, and equipment, we consider the cost to be everything that we paid for it in order to get it ready to use. So it's the cost of the asset plus all of the things that we needed to do to make it ready to use or useful. So if we buy a large machine for our factory, and before we can install a machine, we have to put in a heavier floor to support the machine. So a new cement or a new foundation to support the machine because it's so heavy, that becomes part of the cost of the machine. If we have to bring in a different kind of power to run the machine, so we have to use 220 or 440 instead of 110, and we don't have that power existing, we have to include the cost of bringing the power in as part of the cost of the machine. If there are other things we have to do to the machine before we can operate it, those all become part of the cost of the machine. In addition, let's skip around here a little bit. In addition, you're going to have, as part of the cost of that machine, you're going to have the purchase price, the sales tax, if there is any shipping, any freight that you had to pay to get it to you, insurance while it was being delivered to you, obviously the assembly, installation, and testing we already talked about, and if there are any necessary legal fees to establish title. What you don't include are recurring costs. So if we insure the machine once we have it, in order to operate it, that's not part of the cost of the machine. We have to pay personal property taxes, as most states in the U.S. Assess personal property taxes against equipment that a manufacturer owns. Those property taxes are not part of the cost of the machine. They're ongoing expenses, and they are considered operating expenses. We incur them as we operate. So that's your equipment. Land is, in terms of what we consider as land costs, it's everything, once again, necessary to get it ready to use. So real estate commissions, title search, all of those kinds of things. And then the last two bullet points there are kind of interesting. If we buy a piece of land and in order to get it ready for our use, in order to get it ready to build a building on, we have to either clear it, fill it, or drain it. That becomes part of the cost of the land. if we buy a piece of land with an old building on it. We have to remove the old building before we can build our new building. The removal of the old building becomes part of the cost of the land. Things that aren't part of the cost of the land are things that we add to the land. Parking lots, sprinkler systems, lighting systems. Those are all recorded separately and they're called land improvements. And they actually are, the cost allocation is a little different. Because land, we don't allocate the cost of land. So we figure out the cost, and that cost stays on the balance sheet until such time as we dispose of the land. So if we have owned land for 50 years and we're a corporation, the land is still on our books for what we paid for it 50 years ago. And the accounting reason for this is that we can't determine the useful life of land. So therefore we can't allocate the cost over its useful life because we don't know what the useful life is. Generally, land lasts forever. Not always. Those of us who live on the seacoast know sometimes the land falls into the sea. But in general, land lasts forever, and therefore we're not going to allocate cost or depreciate that land over time because we have no way to know how to allocate it. We don't know how long it's going to last. So land stays on there forever. So any company that you look at, what's important here is the company that you look at, you need to understand that what they have on the books for land may well not reflect true value. It's going to reflect what they paid for it whenever they bought it, and that's it. So it may be worth more or less, significantly more or less than what they paid for it. But it's going to show on their balance sheet as an asset at cost. And then buildings, much like equipment, we're going to include any costs necessary to get them ready to use. So what we pay for it, commissions, legal fees, remodeling, if that's what's necessary to get it ready to use. If we're building a new building, we're going to include the architect's fees, cost of materials, labor, and then the one sort of twist on building a building is we include the cost of the interest. If we have a construction loan to build a building, the interest cost gets added to the cost of the building while the building is under construction. Once the building is complete and we acquire a mortgage on the building, that mortgage interest expense is an operating expense. But while the building's under construction, the interest gets added to the cost of the building. So, to term some specific jargon or terminology that you're going to run into, accumulated depreciation is a contra asset. That's the first time you've heard in this class contra, and related to the balance sheet. Contras are essentially negative. So there are contra assets, there are contra liabilities, and there are contra equity accounts. They show up on the balance sheet in the asset. For instance, a contra asset will show up in the asset column, but as a negative. So accumulated depreciation is a contra asset. And what it is the total depreciation taken on the assets to date. So if we're 3 years into the life of the asset, the accumulated depreciation would show the depreciation for year 1, year 2, and year 3 as a total, and it would be negative. So we'll talk about that. Maybe you saw some of that when you were looking at the financial statement that you were assigned on the SEC site. Book value. Book value is the cost of the asset minus the accumulated depreciation. So cost minus accumulated depreciation gives you net value or book value. So plus the cost minus the accumulated depreciation ends up with book value. Service life or useful life is an estimate, and it's what we expect the asset to generate benefits to be useful to us, how long we expect it to be useful to us. So If we were talking about an automobile and we expected it to last 5 years, then the useful life or the service life that we would use would be 5 years. And then finally, many assets have some value even if they're no longer useful to us. And that's called either residual value or salvage value. So at the end of the useful life to us, there may still be value in the asset. So if we expect our delivery trucks to last 5 years and be useful to us for 5 years, at the end of their 5-year life, they probably still have some value and we can sell them for that value. So that's the salvage value or the residual value. So for tangible assets, there are 3 kinds of cost allocation that generally accepted accounting principles allows. So here's the first place you've seen where companies or management gets to decide how to record an accounting transaction. Should we use a straight line method to allocate our tangible assets? Should we use an accelerated method, or should we use an activity-based method? All of them are valid. All of them are acceptable for generally accepted accounting principles. They all give us different answers. So you can have one company that has chosen to use straight line depreciation, and you can have another company that's chosen to use accelerated depreciation. They can have exactly the same set of transactions, exactly the same operating expenses, everything exactly the same, and they will show a different level of income, and they will show a different level of assets because they're using different methods of cost allocation. So let's talk about the different methods of cost allocation. Straight line, pretty simple. We expect the asset, let's say it's a $10,000 asset. It has no residual value, and we expect it to last for 10 years. We're just going to take the 10,000 divided by 10 years, and we're going to allocate $1,000 per year of costs to that asset. So we're going to start out with a $10,000 asset. After year 1, we will have a $10,000 asset and $1,000 of accumulated depreciation for a net value of 9. And we'll also record $1,000 of expense to match with the income that the asset generated. Say year 2, we'll do exactly the same thing. $10,000 asset, $1,000 of expense, and $2,000 of accumulated depreciation, and so forth. So at the end of 10 years, remember I said we didn't expect this asset would have any residual value. At the end of 10 years, we'll have a $10,000 asset with $10,000 of accumulated depreciation and no book value. So that's straight line. And that makes sense, right? I mean, from a rational standpoint, it's gonna last 10 years. We're gonna spread the cost over 10 years evenly over 10 years. Accelerated depreciation looks at depreciation or cost allocation differently. It says this asset is more valuable and more productive early in its life than later in its life. So use the automobile example or the delivery truck example again. If I have a delivery truck, a new delivery truck, it's very, very productive. It doesn't have any time in the shop. It doesn't have any downtime. It doesn't break down. It doesn't need service. So it's extremely productive in its early life. As its life goes on, more things start to go wrong. So I have more downtime, therefore less productivity in the asset. So therefore, to match the cost allocation to the revenue generation, I want to allocate more of my costs early in the life of the asset, and less of the costs later in the life of the asset. That gives me a better match. So accelerated methods are allowable for GAAP because they mimic or come closer to reality in terms of how assets are actually used, or the revenue that they generate. So there are lots of different kinds of accelerated methods. I'm not going to ask you to learn them, The most common one is called double declining balance. There's also 150% declining balance that's acceptable as a sum of the year's digits method. And then we'll talk a little later on about MACRS, which is the IRS accelerated method. It stands for Modified Accelerated Cost Recovery System. Big, that's a mouthful. And then the third method is called activity-based depreciation. And activity-based depreciation is a method that is used for natural resources always, but can be used for tangible assets. So if you notice under each of these methods, straight line, accelerated, and activity-based, I've said for straight line, we can use it for tangible assets if we choose, and it's required for intangible assets. It's the only method you can use for intangible. They have to be amortized on a straight line basis. Accelerated methods are only available for tangible assets. You can't use them for intangible assets or natural resources. And activity-based we can use for tangible assets. So instead of establishing a useful life in years for our delivery truck, we could establish a useful life in miles. And then we could allocate costs based on how many miles we drove each period or each year. Activity-based cost allocation is required for natural resources, so you don't have a choice. So different kinds of a comparison of accelerated methods and straight line methods. Notice that the total over the 6 years of this example is the same. We're going to allocate $21,000 of cost over 6 years. What's going to change is how much we allocate in each year. So in the straight line method, we're going to take $3,500 per year as a cost allocation. Double declining balance, much more, $8,000 in the first year, but only $100 in the 6th year. And some of the year's digits, 654,321. So you're going to take much more in year 1 than in year 6. So those are three, a comparison of straight line to accelerated methods. I'm not going to ask you to learn how to do DDD or some of the year's digits depreciation, just know that they exist. But I will ask you to learn how to do straight line depreciation. And straight line depreciation, your formula is there. Straight line depreciation is the cost of the asset minus the estimated residual value divided by the asset's service life. So that's a straight line depreciation method, and that gives you the answer to that gives you the annual depreciation rate, and it will be the same for the useful life, the service life of the asset. So we've already described that, but if we took an $11,000 asset with $1,000 residual value, we'd have it, that would 10,000 minus 1,000, 11,000 minus 1,000 gives you 10,000. Asset service life of 10 years, we'd have $1,000 per year cost allocation or depreciation. So I'm going to use give you some examples here, and this is an example of a juice machine. I don't know if any of you have ever been in a hotel where they had the automatic orange juice machines where you can take a fresh orange, put it in the top, hold your glass underneath, and get fresh squeezed orange juice. The machine just squeezes it for you. I think they're really cool. I've been using this example for a while. Those machines usually sit in the breakfast room of a hotel, usually a somewhat fancier hotel, and you can get fresh squeezed orange juice. So the example here is on January 1, 2003, this hotel purchased a juice machine for $11,500. Equipment has an estimated useful life of 6 years and an estimated residual value of $500, and it cost $1,000 to get it delivered and installed in the breakfast room in the hotel. So how do we calculate the straight line depreciation? Well, it's pretty easy. We know our cost. Our cost is the 11,500 plus the delivery and installation costs, because we needed that to get it ready to use so our total cost is 12,500, and we have a residual value of $500, and we have a 6-year life. So your formula, cost minus residual value divided by life, 12,500 minus $500 divided by 6, we have a depreciation of $2,000 a year. Pretty simple to do, makes a lot of sense. And something like over 90% of publicly traded companies use straight line depreciation because it is simple to use. It does make sense to non-financial people, and it tends to, relative to the other methods, or certainly the accelerated method, it tends to end up reporting somewhat higher income, which publicly traded companies like to report more income. Privately traded companies often use other methods, and some publicly traded companies do as well. This is the most common method. Units of production method, same information as the last one, except now we're adding one more thing. We know that over its useful life, the machine can squeeze 240,000 glasses of juice. Still has a $500 residual value at the end of its life. What's the depreciation rate per glass? Well, that's pretty easy to figure out. You've got a $12,500 asset with a $500 residual value, so a net of 12, divided by 240,000, it's going to give you, I believe, 5 cents per glass is the depreciation rate, or the cost allocation rate per glass. If in year one we have 36,000 glasses squeezed, we can calculate the units of production method, the cost minus salvage value. You've got here, cost minus salvage value, you've got 12,000 divided by 240 equals a nickel, and 5 cents times 36,000 gives us a depreciation of $1,800. So in the straight line method, we have $2,000 first year. In the units of production method, because we squeezed 36,000 glasses, we have 1,800. Next year, we might squeeze 50,000 glasses, and we'll have $2,500 of depreciation. The year after that, maybe it's, if this hotel is, we've got mountains in the background, if this hotel is in a ski area and there's no snow that year, guest rates are down, we're not squeezing as much orange juice, so maybe we only squeeze 25,000 glasses of juice and have whatever that works out to, $12,500 of depreciation. So we're going to match the depreciation with the actual revenue generation. We're generating revenue, we're going to match the depreciation. So I'm going to stop there, ask you a few questions, and then we will continue with chapter 13. Thank you.